Hey, welcome to The Explainer. Today, we're going to break down the absolutely essential accounting and tax rules for trading equity derivatives in India. And we're getting our info straight from the source, the official workbook from the National Institute of Securities Markets, so you know this is the real deal.
So let's kick things off with the one question that's on every single trader's mind. Look, making a profit is great, but that's only half the story. Understanding the behind-the-scenes stuff, the accounting, the taxes, that's what actually determines how much cash you walk away with. All right, so here's how we're going to tackle this. We'll start with the accounting for futures. Then we'll move on to options. After that, we are going to bust a huge myth about so-called speculative income. And finally, we'll wrap up with what you need to know about your taxes.
Okay, let's dive into part one, accounting for futures. We're literally going to follow the money from the moment a trade is opened to the moment it's closed.
The very first thing you do is post your initial margin. Now, this is so important to get right. It is not a payment. It's more like a security deposit. It's collateral to show you're serious. In your accounting books, it's actually listed as an asset because, well, you're supposed to get it back.
When you boil it all down, the entire life of a futures trade, from an accounting perspective, really just comes down to these three key moments. You put up the margin, you handle the daily price swings, and then you have the final settlement where everything gets squared away.
And that brings us to this idea of mark-to-market, or MTM. It's a core concept in the futures world. See, instead of waiting until the contract expires to see who won or lost, the exchange settles up every single day. If your trade is up, cash gets credited to your account. If it's down, it gets debited. It's a daily reality check. So when you finally close out your position, either at expiry or whenever you decide to exit, all those little daily MTM adjustments are tallied up to give you one final number. That's the official figure that goes into your profit and loss statement.
All right, part two, let's talk about accounting for options. This gets a little more interesting because the rules are completely different depending on whether you're buying the option or selling it. And here is the fundamental difference. If you're the buyer, you pay a premium up front. That's it. That's your maximum risk, and it gets booked as an expense. No daily margin calls for you. But if you're the seller, it's the other way around. You receive the premium, which is great, but you also have to post a margin and deal with those daily MTM adjustments, just like with futures. Two totally different worlds.
Okay, part three. And this is where it gets really crucial for your bottom line. Let's talk about the speculative income myth. How does the government actually view your trading profits? Because a huge change in the law completely redefined the game for every derivatives trader in India. So you gotta ask, is trading derivatives just seen as a form of gambling by the tax authorities? For a very long time, the legal answer to that question created a massive headache for traders.
This was the old way of doing things. Before 2005, any money you made or lost from derivatives was officially classified as speculative. This meant if you had a loss, you could only use it to cancel out all their speculative gains. You couldn't use it against your other business income, which was, well, incredibly restrictive. But then, the Finance Act of 2005 came along and changed absolutely everything. This one little sentence in the law was a bombshell. It explicitly said that if you're trading derivatives on a recognized exchange, it is not a speculative transaction. Just like that, it was legitimized as a proper business activity. So why does that matter? Oh, it's huge. It means if you have trading losses, you can now use them to lower your taxable income from your other business activities. And if your losses are too big to use in 1 year, no problem. You can carry them forward for up to 8 years. The flexibility this gives you is just massive.
All right, on to our final section. Now that we know derivatives trading is treated as a non-speculative business, what are the actual tax rules? Let's get into the nitty-gritty of things like STT and audits.
First up is STT, or Securities Transaction Tax. The easiest way to think about this is like a small transaction fee that's collected automatically. You don't have to file a special return for it or anything. The exchange just takes it out when you trade. It's just a standard cost of doing business. Now, this table breaks down the different STT rates for you. You'll notice a pattern here. For both futures and options sales, it's the seller who pays the tax. The only time the buyer gets hit with STT is in the specific case where an option is actually exercised. Okay, beyond just paying your taxes, there's the compliance side of things. Do you actually need to hire a chartered accountant to formally audit your trading books? Well, the answer is, it depends. It all comes down to your turnover and your profitability.
The rules are pretty specific. You absolutely need an audit if your total turnover goes over 10 crore. And a quick note,
For derivatives, turnover isn't the total value of your contracts, it's the sum of your profits and your absolute losses. There's also a special rule for those in the 2 to 10 crore range. If your profit is less than 6% of your turnover, you'll need an audit too.
So, let's just bring this all home. The big takeaway is this. In India, derivatives trading isn't seen as some Wild West gambling. It's treated as a legitimate business activity with a very clear, structured set of rules for how you account for it and how you pay taxes on it.
So I'll leave you with a final thought. Being a great trader isn't just about calling the market right. It's about understanding the entire financial machine you're operating in. Now that you know these rules, does it change how you see the risks and rewards of your next trade? Because it